Intel is currently trading at a stock price near its 10-year low. So is this a good time to pick up this company? We will try to answer that using 5 different intrinsic valuation models. So stay tuned until the end of the video to get the answer to whether this stock is currently trading at a discount. The stock screener and intrinsic valuation tool used in this analysis is available at my Patreon page, and you can find the link to that page in the description below. To take a closer look at Intel, we will use this fully automated stock screener. All we have to do is to write in the stock ticker symbol for Intel. The spreadsheet will then load in the data. As you can see, Intel is currently trading close to $29, and the stock price is very close to its 52 weeks low. If we look at the performance during the last year, we can see that Intel has dropped heavily in stock price. And if we look at the 1-year performance, it is down 47%, and the year to date is down 44%. But what if we go even further back in time? Let's try to go 10 years back. And as we can see from this graph, during the last 10 years, Intel's stock price has gone up until the last year when it has dropped heavily. And right now Intel is actually trading at its 10-year low. This could potentially make an interesting buying opportunity if Intel can turn it around. But let's go back to the 1-year performance. So Intel is right now currently trading at a really low PE value. And if we look at the beta, we can see that it is below 1, indicating that this stock is normally less volatile than the general stock market. The analyst has a 1-year target price for Intel close to $40. And the price to sales and price to book are also really low. And if we take a look at the RSI, it's quite interesting because normally an RSI under 30 indicates that a stock could be oversold. And right now Intel is close to 25, indicating that this stock is actually oversold at the moment. If we look at the dividend, because many investors will probably pick up Intel due to its high dividend yield, then the yield is currently sitting at 5%, which corresponds to a yearly dividend of $1.46. And the payout ratio is just over 30%, which is not that high. To analyze if this stock is currently trading at a discount, we will use 5 different intrinsic valuation models. And if you watch to the end, we'll get an answer if this stock is currently trading at a discount according to the intrinsic value. But before we go to the intrinsic analysis, just a short disclaimer. I'm not a financial advisor, and the following content is only for educational purposes and should not be considered as financial advice. The first model we will use is Graham's valuation, invented by Benjamin Graham. On the left side we have his original valuation, and on the right side we have a revised version of his valuation model. The difference is that the one on the right side is less aggressive, as it uses 7 for a PE of a company with no growth instead of 8.5, and to that is added 1 times the company's growth rate projection instead of 2 times. This spreadsheet is almost fully automated. All we have to do is to find the growth rate projection of the company. On Yahoo Finance, the analyst predicts a negative growth rate of 0.16% for Intel in the next years. So here I've just added 0, so no growth for this company to keep it simple. And when we do that, we get an intrinsic value of $40.82 for Graham's valuation, his original valuation model. And in the revised version of the valuation, we get a $33.61. And that is 16% over the current stock price for Intel. So depending on which model we use, when we add our margin of safety, we either get a buy or a sell signal. Our next intrinsic valuation model is the multiples valuation model, also called the comparable company analysis model. And this is a quite simple model where we find companies that are similar to Intel. The spreadsheet then imports the PE values for these companies and find the average PE, which is then multiplied by the earnings per share for Intel. This gives us an intrinsic value of $81.75, which is almost 3 times as high as Intel's current stock price. But currently I don't think this is a good model for Intel, and that is because we have a company with no growth, which we then compare to companies where we expect a certain growth in the next years, and therefore their PE values will of course be higher than the one we have for Intel at the moment. And when that is multiplied by the Intel's earnings per share, we get this really high intrinsic value. The next intrinsic valuation model is Peter Lynch dividend adjusted fair value. And here we find Peter Lynch fair value by taking the earnings growth rate, add the dividend yield, and divide by the price to earnings. And again, this spreadsheet is fully automated, so it automatically calculates Peter Lynch fair value. For Intel, we get a Peter Lynch fair value of 0.82. And when we compare it to this table over here, we can see that a fair value below 1 means that the stock is currently overvalued. By using Peter Lynch's assumptions that a fairly valued company equals 1 and that a fair PE value equals the company's growth rate, then we can rewrite this equation. And when we do that, we get a fair stock price of $23.58. And that is below Intel's current stock price. So when we add our margin of safety of 25%, we get a really low acceptable buy price just under $18. The next model is the dividend discount model. And this model is quite interesting for Intel as it is currently paying a high dividend to its shareholders. And here we can find a fair value by taking the next year's expected dividend divided by the discount rate minus the growth rate. And here I've then added the quarterly dividends for Intel for the last 6 years. And the spreadsheet will then calculate the growth rate for each year and the average growth rate, which is 6%. But I think 6% is too high for Intel going forward, so therefore I've added a custom growth rate, which is a bit more conservative at 4%. And then I've set the spreadsheet to take the custom growth rate in order to calculate the fair value of the stock. And when we take this growth rate, we get a next year's expected dividend of 1.52. And then I've added a discount rate of 8.5%. And by using these numbers, we get a fair value of $33.74. And then by applying our margin of safety of 25%, we get an acceptable buy price for Intel of $25.31. And as this is below the current stock price, we'll get a sell signal using this model. Our final intrinsic valuation model is the discounted cash flow model. And here I've added the cash flows from Intel for the last 11 years. And the spreadsheet has then calculated the growth rate each year. And that is used to calculate the average growth rate, which sits at 3.65% for Intel. And you also have the option to add a custom growth rate if you choose to, and then tell the spreadsheet which one to use. And for this analysis, we'll just use the average growth rate. I've then added a discount rate of 8.5% and a perpetual growth rate of 2%. And these values are used to extrapolate the future free cash flows into the future. And here I've done that for up to 2030. And after that we add the terminal value. And that gives us the sum of the future free cash flows. And to that we add the cash and cash equivalents, subtract the debt, and that gives us the equity value, which we can then divide by the shares outstanding to get the discounted cash flow fair price. And that sits at $37, which is above the current stock price. So if we add our margin of safety of 25%, we get an acceptable buy price close to $28. And that is below our current stock price, and therefore the spreadsheet will give us a sell signal. On the final page we have the summary and watch list. And here we have a summary of our 5 different intrinsic valuation models, together with the intrinsic value each model found. And if we look at these, we can see that Graham's revised valuation, the dividend discount model, and the discounted cash flow model all give results that are quite similar, where Peter Lynch's dividend adjusted fair value gave a result that are almost $10 below these. However, the comparable company analysis gave an intrinsic value that is almost 2.5 times higher than the others. And as we also discussed earlier, I will not put much faith in this, and therefore I will choose to exclude it from the calculation of the average intrinsic value. So when we do that, we get an intrinsic value of $32.01. And that is above our current stock price. However, the difference is only 11%. So when we add our margin of safety of 25%, we get an acceptable buy price for Intel just over $24. And therefore the spreadsheet will give us a sell signal. This indicates that Intel is currently not trading at a discount that allows us to have such a high margin of safety. But we can add the stock to our watch list, and if the stock price from Intel falls under $24, the spreadsheet will give us a buy signal indicating that now the stock could represent a buying opportunity. The watch list and the portfolio can be found on my Patreon page together with this intrinsic valuation tool. If you like this video, please consider to hit the like and subscribe button in order to get more content like this in the future. And until next time, have a great week.